Imagine it is June 2026, and the most anticipated stock in history has finally arrived. SpaceX hits the market with a single, non-negotiable price of $135 a share. It is a massive, historic moment that values the company at over $1.7 trillion, and retail investors are practically clawing at the doors to get in. If you have a standard 401k, it is easy to assume you are part of the party. Most people rely on autopiling index funds that are supposed to buy into the biggest American companies automatically. You might think that as soon as a giant like SpaceX goes public, your retirement account quietly picks up a few shares while you sleep. In reality, your retirement fund likely has not bought a single share. Despite the hype and the trillion-dollar price tag, standard 401k investors are currently sitting on the sidelines, completely disconnected from the IPO. The headlines are focusing on the rockets and the stock ticker, but a quiet rule change is already rewiring the plumbing of your 401k. While you watch the fireworks, the way your retirement money is managed is being fundamentally shifted behind the scenes. To understand why your money is missing out, you have to look at the S&P 500. This is not just a list of the 500 biggest companies. It is more like an exclusive VIP club. There is an actual committee of human beings acting as a bouncer at the door, and they have very specific rules about who gets in. The bouncer's ultimate rule is profitability. To join the index, a company must prove it can actually make money, specifically showing a real profit over its most recent 4 quarters. It does not matter how famous the CEO is or how high the valuation climbs. If there is no profit on the bottom line, the door stays shut. This is where the SpaceX story gets complicated. Their Starlink satellite business is a massive success, beaming internet all over the globe. But the company is pouring every cent of that profit, and billions more, into experimental technology and AI infrastructure. In the narrative of this IPO, those massive investments show up as a $5 billion loss on paper. Because the S&P 500 index protects your retirement from money-losing ventures, this trillion-dollar giant is actively blocked from your 401k. It fails the bouncer's test, which leaves it standing outside the most important club in finance. Since the front door to your retirement account is locked by those strict index rules, Wall Street has engineered a shady back door to get to your money anyway. A recent rule change in Washington now allows private equity and pre-IPO investments to bypass traditional safety guardrails. This order directs the Department of Labor to let expensive, unproven private assets flow directly into everyday 401k plans for the first time. The financial industry markets this as democratizing access. They want you to believe that you are finally being invited into the inner circle, getting the same chance to invest in private companies that used to be reserved for the ultra-wealthy. This backdoor is a meticulously designed trap. It is built around 3 specific catches that are structured to quietly siphon wealth away from your future and into the pockets of fund managers. The first catch is the cover charge. A standard index fund in your 401k today costs almost nothing, pennies for every $10,000 you invest. These new private funds, however, charge annual fees of 1% to 2%. They take that cut every single year, whether they make you a dime or lose your shirt. Let's see what that looks like over 30 years. If you start with $100,000 and it grows at 7% in a cheap index fund, you end up with $750,000. But if you take that same growth and apply a 2% fee, your final balance is only $430,000. That fee quietly vaporized hundreds of thousands of dollars. More than 40% of your potential wealth simply disappeared, transferred year after year from your retirement to someone else's bank account. The second catch is the locked exit. With normal stocks, you can sell and get your cash instantly. Private funds can legally lock your money up for months or even years. They restrict when you can take your money out, sometimes shutting down withdrawals entirely if they decide too many people are trying to leave at once. This creates a nightmare scenario during a market crash. If you lose your job and need your own savings to survive an emergency, your 401k could literally tell you that your cash is unavailable until the next scheduled window. The third catch is the timing. The explosive, life-changing growth of a company usually happens while it is small and private. By the time these companies are deemed mature enough to be dropped into millions of retirement accounts, they have already reached massive valuations. Take the history of SpaceX. Early investors turned a $20 million bet into $50 billion, while the public was legally barred from investing. That vertical climb on the chart happened entirely in private, long before the IPO was even a conversation. When these assets finally reach your 401k, you are buying in at a sky-high price. The massive upside that made the early investors rich is already gone. Wall Street is inviting you in only after the early insiders have taken their profits. Your retirement account is being used to provide the cash those early investors need to finally walk away from the table. This rule change is being pushed by massive firms like BlackRock and Empower. These companies are eyeing the $12 trillion currently sitting in American retirement plans. They know they can collect billions in new fees by moving your money out of cheap index funds and into these expensive private accounts. There is a growing group of critics fighting back. Regulators and political figures like Elizabeth Warren have raised alarms about dumping life savings into risky, opaque markets. Their job is to protect you from predatory risks, and they are increasingly worried about what these changes mean for your financial security. When the world's largest financial firms and government watchdogs are fighting over who gets to control your money, it is time to start paying very close attention to the fine print. You can protect yourself by taking one simple step. Log into your 401k this week and find your expense ratio. This is the fee you pay to have your money managed. If you are in a low-cost automated index fund, your main job is to make sure you stay there. As Wall Street pushes new options into your plan, ignore the marketing buzzwords. Whenever you see a fund described as exclusive or sophisticated, ask yourself two things. What is the annual cost? And can I get my cash out the moment I need it? Boring index funds have quietly built wealth for millions of people without the high fees or the locked exits. They are one of the most powerful tools ever created for regular workers, and they work best when you ignore the hype. The best way to win this game is to refuse to play it. You do not need a backdoor IPO or an expensive private fund to succeed. Stay focused on the tools that have already proven they work, and keep your retirement money out of the trap.